Hello everyone, I'm Renee Lobo and welcome to the Renee Lobo Report, bringing you issues of topical interest. Tax filing could be very cumbersome, tedious, at times it could be very overwhelming, and that's why you need some tax experts to give us tips and advice how to plan for the next year, because April 17th for this year has already come and gone. But the final day to file your U.S. tax returns is October 15th, and then a couple more dates. June 30th is for your FBAR. If you have any foreign bank accounts, that's June 30th. That's a deadline for it. And July 31st is if you're NRI filing tax returns. And today, our two tax experts are back and going to tell us all about the tax proposed changes for 2013 and how you can start planning at this point for next year so you can save more when you're filing your taxes for next year. So talking to us, we have Vinay Navani, who's with Wilkin and Gutenplank. Thank you very much for coming back. And Cecil Nazareth from IFRS Partners, and both are experts in tax filing, especially offshore compliance issues that are very, very important. We have discussed that before many, many times, and we keep on reinforcing because it's better to pay than get all those penalties later on. So let's talk to our tax experts. We know the three dates: October 15th, the final day to file, as well as June 30th for FBAR reporting, and then July 31st for your NRI filing for Indian tax return.
Let me just make one comment that the October 15th deadline is a deadline if you got an extension.
If you not have an extension, then
you just need to get your return filed as soon as possible.
So would there be a penalty if they're
not filed for an extension? If there's tax due, then there's a penalty, but
if there's no tax due, then I
there's
guess
no
it's
penalty.
Over. I see.
Correct.
Okay, so that's very important. If you ask for extension, then October 15th. Otherwise, God help.
Right, and the June 30th date for the FBAR, that's absolute deadline. There's no extensions available. So that's a very important date to know if you have foreign bank accounts that you need to report to the Treasury.
That's why compliance is the need of the hour. We've discussed that many, many times. So let's look at the 2011 tax returns. You know, if somebody owed something and you got a refund.
Sure.
All that.
So you know, we spend so much time talking about offshore items. Let's talk about, you know, your regular tax planning, how to save money now. So if you filed your tax return April 15th, either one of two things happened. You either owed money or you got a refund. If you owed a lot of money, maybe you may have had a penalty. Okay, because the IRS wants you to pay taxes more or less as you earn it.
So by now they would have gotten something in the mail?
Maybe not by now, but within the next few months they would have gotten a notice. It doesn't all, there are some exceptions, but for the most part you shouldn't be owing a lot of money with your tax return. So if you did, you need to look and see, maybe you need to increase your withholdings, maybe you need to make estimated tax payments, or maybe you just had an unusual item of income. Maybe you sold a stock at a large gain, and maybe it's not going to happen again next year. Now, what's more common is people get big refunds, and everybody likes refunds. But what if I told you I'm going to give you an investment that you give me $1,000, I'm going to give you $1,000 a year from now, I'm not going to give you any interest. I mean, people wouldn't think of that as being a good investment. And that's what you're doing if you're getting large refunds back. Okay, so you think about reducing your withholdings, getting the money back every week, it all back at the end of the year. Okay, some people like getting that big check and it forces them to save, and if that helps you save, then fine. But also think,
you know, a lot of times we do a lot of donations, charities, and that's something important for us to
charities are very important when it comes to tax planning, and obviously you're doing a good thing for other people by donating to charity. So some main issues with charity are, let's talk about the non-cash items. Okay, we all go through spring cleaning. We all like to clean out our closets and donate clothing and household goods to people less fortunate. So that's a great thing.
Do you need a receipt or something?
What you should do is you should keep a good itemized list of what you give. Okay, so 14 shirts, 12 pants, 8 pairs of socks.
How's it documented?
Okay, so you first keep your internal documents, your internal list. Okay, then you go to a recognized charity like Goodwill, Salvation Army, and they will give you a more general receipt saying you donated X boxes or X bags of clothes. And then what you have to do is you have to claim a tax deduction, you have to use the cost at which the Salvation Army or the Red Cross would actually sell it for in their thrift shop. Okay? So you might have a $100 shirt and a $20 shirt, and they're both going to sell on the rack for $2.
Right,
Okay,
right.
so that $2 is the value of your charitable deduction. Okay, so it's very important.
Can't put $100.
They can't put $100, even if they use it. It means it's a great shirt.
Now, what about books?
Books, same thing. You would look at the used book price, and Salvation Army will give they have a price list
Right.
for their thrift shop, and they will tell you, and it's probably going to be $1, or $2. It's going to be a small amount. You're not going to save a ton of money in taxes, but you're doing a good thing to help other people, and you're getting a tax benefit, so it's worthwhile. Along those same lines, many people will do activities to help out a charity, and to the extent that you go out of pocket for that could be a charitable deduction too. So I have clients that will do Meals on Wheels and will drive around meals to elderly people. So they don't get reimbursed by the charity for their driving cost. So they're allowed to deduct that mileage as a charitable deduction.
Right.
Okay, so lots of things like that.
Sometimes canceled check is not the answer to many of
Correct. The IRS is very strict about asking for substantiation or receipt from the charity itself. Okay?
But a canceled check is not
for
sufficient.
small amounts, it's okay, but for most times, you really want some acknowledgement from the charity.
What's a big amount? What's a small amount?
The threshold, I think, is $250.
I
Okay,
see.
but I would suggest even if it's lower than that, I would get a receipt from the charity, because I've had many times the IRS has sent my clients notices saying, please send us documentation of your charitable contribution.
Right.
So that's very important.
What about yes, Cecil?
Add to that too also, documentation becomes a very integral part of validating or substantiating a deduction. You cannot pull a number out of thin air and say my deduction is $2,000. Right. So the more documentation you have, the stronger
Substantiated.
your case. Substantiation. And it applies in all tax law. So it's, I just want to make this point because we receive clients, both Vinay and myself, and they say, I spent $2,000 on charity. Right? But that is not a valid substantiation in the eyes of the government. Now you go to church, you donate some money to the church will give you a receipt.
Right.
Any place, the temple will give you a receipt.
And hold that, save the receipt.
Save the receipt. So even if you have a 90% threshold on documentation, that's good.
What about standard deductions? Many times you have just a standard deduction.
If you claim the standard deduction, then you don't
Need the receipt.
You don't need the receipt because you're not getting the benefit of the charity. But
Correct.
But you have to know how much. You have to know what all your itemized deductions are to figure out if the standard deduction is better
or not.
Exactly. Very good.
So what about foreign-based charities?
Okay. So
Will that help?
excellent point. Technically speaking, I cannot get a U.S. tax deduction for giving a contribution to a foreign charity.
Right.
Okay. The IRS basically has controls over the charities and has reporting. They want to make sure that that money is not going into somebody's pocket that's using for a good cause.
Right.
So if there is a foreign charity that you are very attached to, a couple of different things you can do. If there's enough people in the U.S. that are giving money to that charity,
Okay.
you can consider actually forming your own U.S.-based charity. It's a little bit expensive, but you can form your own U.S.-based charity, get a special permission from the IRS that you're going to support this particular foreign charity. So I've had clients do that. And the other thing is many organizations in foreign countries have some affiliation with a U.S.-based charity, okay? A church, a temple, things like that. So maybe you can find the U.S.-based charity that's affiliated with the foreign charity and give to the U.S.-based organization. But you can't just simply deduct for the most part, a contribution to a foreign charity.
So you have your own 501c
Correct.
Charity, not-for-profit organization. Make a check out from that, and then send it out to a foreign-based charity.
Correct, but that's the end product. You have to go through a lot of hoops with the IRS to set up that foreign charity and get it approved to support that specific.
An example is the Red Cross. The Red Cross operates in the U.S. I donate to the Red Cross. Now there's an earthquake in one place like Pakistan or somewhere a few years ago. Now they can support that organization because that's their broad mission. Doctors Without Borders.
Right.
You go down this list, you need an approved charity in the U.S. and an ID number. An employee identification number in the U.S. So then that validates your deduction and you're done.
Yeah.
Now what that charity does with its foreign affiliates, it's up to them, and they will have to file a tax return to that.
I see. So it has to be IRS approved kind of a charity,
Absolutely.
legitimate.
Absolutely.
Not every. Many times people do talk during the Christmas season as well. go for, charities that are approved and recognized.
Absolutely.
And not just something that pops up, sometimes.
Not just for the tax deduction, but you want some peace of mind knowing that
True.
there's accountability that your dollar is going to
Right.
the cause that you think it's going to.
I think that's more fulfilling because you
Yes,
know then where it's going. There's accountability out there.
Correct.
What about medical expenses?
Okay, so medical expenses have to exceed 7.5% of your income. Okay,
Right.
so let's say your income is $100,000, just to keep the math easy. You have to add all your medical expenses, and they have to exceed 7,500, and it's that amount over that is going to qualify for a medical deduction. So that's a pretty high
Right.
number. So the real trick is if you have to try to bunch your medical deductions, meaning if it's the end of the year and you can put off something until the next year,
Right.
Eyeglasses or some elective surgery or something like that that's going to be expensive, you want to try to bunch your expenses into 1 year to try to get over that threshold to get some benefit for it. That's the real planning with
Which
that.
means you got to have all the receipts, have a
Yeah.
good idea, track it down.
Correct. Yeah, you have to be kind of thinking ahead. Okay, I'm going to need major dental surgery at the end of this year, so let me think, is there something else I need to do? And put them all together, maybe I'll exceed that 7.5%.
This is where
floor.
tax planning really comes in.
So another option, Renee, is you can set up something called a flexible spending account. That is more employers.
I see.
So it's up to $5,000 is exempt from taxes completely.
Yeah.
So it's called an FSA, flexible spending account. But you got to use that whole amount. You got to elect on Jan 1st that you're going to use $5,000. So you club all your expenses together, like Vinay said, and you'd have your surgeries. I wanted to have cosmetic surgery all these years because my wife keeps telling me that. No, but I'm serious. So you want to bunch it in that 1 year and get the whole deduction rather than piecemeal, because then it'll get spread out. But FSA, that doesn't apply. You get drugs over the counter and a lot of other receipts, co-pays, and
That
all
doesn't
these
count?
deductions. It
No,
counts.
it counts.
It all
all
counts.
co-payments.
Anything that you're not reimbursed by the insurance company, you can use under flexible spending account, up to $5,000 a year tax-free. And that's a really good planning tool. It does not go in through the medical
So
expense
even like,
deduction.
let's say you're going for physical
right from the top.
therapy and you're paying out of your pocket,
Everything
that
out of
also
pocket.
adds on.
Absolutely.
Yes, but the flexible spending account has to be established by the employer.
That is correct.
So
That is
I, as an individual, can't go out and create one on my own.
Yes, it's
What about
employer-based.
1099? Those are,
Maybe,
freelancers.
yes. I mean, because really they're in their own business,
Exactly.
so they probably can.
I see.
Right.
Now, a lot of times people don't know how to put their money, in the right places. IRAs,
IRAs are a great opportunity, and they're overlooked by so many people.
many
so,
people overlook them.
Yeah, it's
Say, oh, that's way out,
Yeah, exactly.
retirement. I don't want to wait till that long time.
even before you get into the IRAs, if you look into the time value of money, and you put $1,000 away when you're 20 years old, and it grows at 5%, you don't touch it, it grows to an astronomical amount.
Exactly.
Because the money keeps compounding on each other, on itself,
Right.
and it grows to a huge amount. So that's kind of the theory behind IRAs. You're putting money into this pot that's sheltered from taxes.
Right.
It may be sheltered temporarily while it's growing, and it may be taxed when it comes out, or it may be permanently sheltered. In either case, it's growing at a great rate.
Right.
So they're a great concept. As the Social Security system becomes more drained, we all have to take responsibility for private savings and putting money away any way we can.
Right.
So there's basically three flavors of IRAs. The first one is, we call it a traditional
Right.
IRA. So that's the IRA where you get a deduction today for putting money in. Okay, and you can put up to $5,000 per year,
Right.
up to $6,000 if you're over age 50. You put the money in, you get a tax deduction. That money will grow tax deferred. You don't pay any tax while it's in the IRA. When it comes out, it will be taxable.
That's after 65.
It has to be after age 59 and a half.
Okay.
But generally, people keep it in there
And
for
then you pay
retirement.
taxes once you
Take it out.
Right.
The idea is that you're hopefully in a lower tax bracket when you take it out. But you've put money away and it's growing tax deferred.
Is there a limit to how much you can put in?
$5,000 unless you're age 50, then it's $6,000.
Okay. So
Per
every
year.
year you can put
Correct.
6,000.
As long as you have to have that much earned income. So you have to have wages
Right.
of 5,000 or 6,000. You put that in and it grows
Right. And that's tax deferred.
tax deferred.
Right. So that's how you're planning your whole.
Correct. And
savings.
there are some limits. You either cannot be covered by an employer plan, or if you are covered, there's some income limits, okay, that vary based on your filing status. The second flavor of IRAs is what we call a non-deductible IRA.
Right.
That's the same thing as the regular IRA, except you don't get a deduction for the money going in.